Trading without the skill to identify proper and high-quality fair value gaps can be extremely risky and may result in significant losses. Fair value gaps, often overlooked by many, represent the footprint of institutional money in the market. They play a pivotal role in executing well-informed trading opportunities and are a cornerstone in the strategies of smart money traders. In today's episode, we are diving into various candlestick fair value gap types, the psychology behind them, and the price actions associated with them that you might encounter in the market, from basic to advanced. But that's not all. We'll break down the key criteria and rules that elevate a fair value gap into a winning trade. So traders, if that's something you're interested in, please give this video a thumbs up to show your support and subscribe to our channel if you are new. So let's get started. Before diving into the basic and advanced features of the fair value gaps, let's have a quick breakdown of market sentiment and see what is the main factor that fuels the market and what is the major psychology behind the market movement. The dynamics behind market movements can be boiled down to two key factors that consistently influence price direction. The first element is the liquidity zones. Market continually seeks to sweep liquidity to generate momentum. Essentially, liquidity serves as the lifeblood of the market, playing a vital role in the market's overall dynamics and functioning. We have extensively covered how to identify liquidity zones in previous videos, which you can find linked in the description. If you haven't watched it yet, you can easily access it through the description of this video. The second factor is the fair value gaps. The market consistently shows a tendency to fill and rebalance the gaps present within it. If you look at this example, you can notice that the price sharply dropped with inefficiency, leaving a fair value gap behind. Subsequently, the price moved back up and filled the fair value gap. Simultaneously, it also moved upward to clear out external liquidity. Once external liquidity was swept, the price reversed back down to fill the most recent fair value gap. This cyclical pattern reflects how the market operates, where price tends to both clear accumulated liquidity and fill fair value gaps. Now let's continue and explore how we can identify fair value gaps from the candlestick perspective in the market. Fair value gaps are typically formed within a three-candle sequence and are easily noticeable on the chart as a large candle. The distinguishing feature is that the upper and lower wicks of the neighboring candles do not completely overlap the body of the middle candle. This creates what we call the fair value gap zone, which essentially fills the space between the wicks and is drawn on the body of the middle candle. However, there is an exception in that we must consider a four-candle sequence to identify a valid fair value gap. When the first candle in a three-candle sequence is an inside bar candle and forms within the preceding mother candle, it becomes necessary to analyze a four-candle sequence to accurately identify the valid fair value gap zone. In situations like this, if we do not consider the mother candle when we are drawing the fair value gap on the chart, our identified zone will not be optimized or valid. For example, in this scenario, if we solely focus on this three-candle sequence to identify the fair value gap without taking into account the presence of this red candle, the identified fair value gap would be incorrect. These concepts are applicable to bearish markets as well. It's important to note that these principles can be applied across various timeframes and any price action-based chart. Now let's see what is the theory behind the fair value gaps. Consider a three-candle sequence as illustrated. Let's say that this bullish candlestick sequence, which created a significant imbalance in the market, occurred in a higher time frame. To analyze this three-candle sequence from the market structure perspective, let's zoom into a lower time frame. Here, we see that the price created a bullish structure similar to the one illustrated. As mentioned earlier, the market consistently shows a tendency to fill and rebalance the gaps present within it. Now let's take a closer look to understand the rationale behind this phenomenon. As you can see, the price created a successive bullish structure to the upside with great momentum, driven by high buying pressure and a lack of sellers in the market. When traders encounter such sharp movements and miss out on a great buying opportunity, they often place their buy limit orders below key zones, such as order blocks and demand areas, hoping that the price will make a deep pullback and activate their orders before resuming its upward movement. This scenario accumulates a lot of pending buy orders in this area, creating a significant liquidity pool awaiting to be swept by the market inside the fair value gap. So, traders' fair value gaps are filled with many buy-or-sell orders, creating a substantial liquidity pool inside the gap. This is the primary reason why the price is likely to return to fill the gaps and then continue its momentum with even greater strength. The presence of these pending orders within the fair value gap acts as a magnet for price, attracting it back to fill the void before resuming its trend. This might provide a great trading opportunity for us. Imagine a scenario where the price experiences a downward movement. In this case, a fair value gap, also known as a liquidity gap, emerges due to the absence of buying pressure spanning across that specific downward price movement. Please note that the identification of the gap is solely based on considering the impulse up or impulse down candle, along with the adjacent candles. Other candles outside this range do not play a role in determining the gap. These pockets of liquidity voids hold significant importance as they can serve as potent entry points due to the market's attraction to liquidity. When the price is inclined to move downward, it aims to clear the potential liquidity zones above it. Consequently, these zones become favorable regions where the price might witness an upward movement, only to eventually fill the gaps and then continue its bearish momentum with greater strength.